you can go read this article on CNBC. I'm not going to go into detail too much, but we stayed at the target range of 3.5 to 3.75. So every couple of Fed meetings, they also do what they call a dot plot. And this is where they pull all the Fed members, and it's a kind of a secret ballot, if you will, and they suggest what they think is coming. And on this graphic, it's showing you what the average is, right? So we're going to take some Fed chair members think rates are going to go up. Some Fed members think rates are going to go down. This is actually a flat. For this year, it's flat, but next year you see a little increase. Anytime you see the dots going up, somebody thinks we should be raising the interest rates. Some Fed members think we should see 2 or 3 rate cuts this year, but they're not the majority. And not every single one of these Fed members is a voting member. Some of the Fed members are just giving their input, but they're not going to actually vote on whether or not we cut rates or not. So we are still thinking that we're going to see a rate cut between now and next year. And the Fed members think we're going to see rates stay flat. And if you go Google mortgage forecast, you'll see a Yahoo Finance article that comes out about every 2 to 3 weeks with updated information. The Mortgage Bankers Association and Fannie Mae, they also both think rates will be flat for the next few years. When we look at the CME group, this is the FedWatch Tool. And what this actually analyzes is economists that bet, if you will, by buying future contracts on the Fed funds rate. So they're actually betting with their dollar on short-term contracts what they think the rates are going to do. And they extrapolate that betting or those trades, and they put a percentage of what we think is going to happen. Now, the next Fed meeting is April 29th. And according to this, there is a 7.2% chance we see a Fed rate hike at the next Fed meeting. If you scroll down to the bottom of the page, you can see where we are right now, and then you can see the probability and the historic probability. So it goes back a day ago, a week ago, and a month ago. So a day ago, it was a 100% chance we're not going to cut rates. We didn't cut rates. It was spot on. It almost always is spot on. But a day ago, there was not an indication that we would see rates go up. And right now, we've got 7% chance of rates going up. So when we fast forward to June, that potential for rates going up increases. This is where we're at now, between 3.5 and 3.75. They can't say 3.625, but that's really where it is on the current rate. When we look at July, there's a 61% chance that we're going to see rates stay the same, a 32% chance we see rates cut, and a 5% chance we see rates increase. So if you go out and look at next year, there is some economists that are voting that next year we're going to have higher rates than we have this year. More of them are going to say we're going to stay the same. We're sitting in here this 3.5 to 3.75 range or lower. So we'll have to watch, between the Fed dot plot. This is softened. They did think, if you looked at the last dot plot, they thought we would see 2 or 3 Fed rate cuts this year and maybe another 1 or 2 next year. And now it's kind of looking like maybe we see 1 rate cut this year. And there is a potential that we see rates go up. So oil has really just overridden a lot of the news that we would normally see. We're going to take a quick look at the charts. The easiest thing for most people to watch is the 10-year Treasury. You can just Google US 10Y, and we see a spread of over 2%. We had kind of gotten this spread down between the 10-year Treasury and average mortgage rates. Historically, the average is 1.75% spread. So if we were in normal historic times, we would expect interest rates to be right at 6% right now, with a 1.75% premium over the 10-year Treasury. But we've actually seen, with this inflation data and oil data coming in, we've seen that spread widen. We had gotten under 2% spread, and now we're back up over 2%, which is an inflationary sign. When we look at average interest rates in America, this was the 27th. Look at that, 5.98. Man, if you locked in, you're feeling good right now. And then today we're at 6.43. So we've seen rates go up almost 0.5% in a couple of weeks because of this oil situation. And that is going to be the main news and the main headline. The longer this conflict goes on, the worse it's going to be for us borrowers and everybody else in the world as well. So we want this to wrap up. I did go pull the investor rates. So if we do a conventional loan today, This samples out where rates are across a whole bunch of lenders. This searches about 100 lenders that I have access to. And today, Penny Mac had the best investor, 20% down, Fannie Mae, fully underwritten. You would actually get a little credit. So this shows a green number, which means you'd get paid. I just did a $350,000 purchase with 20% down. You'd get paid $588 from the lender, or you could pay $451 and get a 6.875.